What's going on, everyone? This is MK Stocks and welcome back. Now, I had a few requests to go over some key basics for trading. With so many new traders coming on board, I thought it's a great time to go over 5 key things every trader should know. Just remember, this is for entertainment purposes only. Please do your own due diligence before getting into any stock or share. But without further ado, let's get right into it. So, 5 things I'll be taking you through today: market caps, stop loss, doing your own research, risk management, and how to enter and exit stocks. So, what is a market cap? Market capitalization, or a market cap, is basically a way of understanding how much a company is worth. Now, it's not the only way to assess a company's value, but it gives you a good understanding. And how you can work this out is you take the share price of a company and you times it by its outstanding shares, and that gives you a valuation of the company to go with. So, here's an example below with the Motley Fool have shown from Costco. I'll let you read that yourselves, but it gives you an idea of, a company's worth. So if we look at the different companies, there are so many different companies, and they basically fall under different categorizations based on this market cap, right? So you got small cap companies, what we call them, which are valued between 300 million and 2 billion. Now, these companies are, there's pros and cons. Basically, the pros are that there's a lot of potential for upside growth. Because they're valued so low, the potential for the stock price to rise tenfold is a lot more likely than take a large cap company where it has already been valued so highly that it may take longer, might be harder for it to reach, as much of a high as small caps. Now, on the other side of the coin, you've got the volatility. So with small cap companies, we often find that they're a lot more volatile. It's a lot more of a riskier play. The companies are a lot smaller and in their earlier phases. So there could be higher chances of things like bankruptcy or fraudulent practice or other issues that might come up. I've listed a few examples for you to have a look at there under the small cap companies, but those are sort of 2 key, sort of 1 pro, 1 con of going into them. Now we've got the mid-cap companies. Now these companies are a little bit more recognized. They have a bigger footprint in their industry, often ranging from the 2 billion to 10 billion market cap range. Got a few examples there. And really it gives the investor a bit more confidence in the company, and it has that still upside potential for more growth. So often it's a good area to look into when you are investing in a company. Now, on the other side, you've got large cap companies. These are 10 billion to 200 billion pound companies. They are leaders in their fields. Examples are AT&T, Salesforce, and Viva Systems. They will have a large footprint in the industry. Now, the plus side is they're a lot more stable. So you'll find that, over the long term, if you are investing money in a lot of these companies, even with sort of crashes and corrections, you'll find that over time, a lot of them will continue to do well or sort of even out. Now, the downside is the potential upside can be limited. Now, obviously, that's not always the case, but especially when you compare it to small caps where, that market cap could rise quite significantly, it's less likely to do so in the large caps. Now, you've also got sort of the mega cap companies, your Teslas, your Apples, your Microsofts, and it's the same for them really in terms of, you've got a lot more stability, but upside growth, it could be a limiting factor. Not always, but it can be. Now, on the other side of small cap, you've got micro cap companies as well. So that's anything under the 300 million mark in terms of market cap. Now, these can be extremely volatile. You've got to be very careful with these. But again, the potential to do well is big. So, and it's all about when you're looking at investing, diversification and sort of risk management, and two areas that I will come on to, but we'll keep those in mind. Now, another question that I got a lot was about stop losses. What are stop losses and how can we use them? Well, when trading, now there's ways of sort of managing your risk. So a stop loss is one way of doing that. And what it is say you buy, we've got an example here, say you're buying Apple shares, you bought 100 of them at $100 with a stop loss of 95. Now, if the price of Apple falls below that 95 range, your position will be sold out at the market rate without you having to do anything. So it protects you in case there's a massive drop. And you can set that at whatever range you want. A lot of these platforms let you do that manually. But if you want to be a little bit more cautious, or you want something that is sort of automatically updating for you, there's a trailing stop loss. Now with trailing stop losses, they are constantly moving. So say you've got an example again with Apple, say you've bought 100 shares of Apple at $100 and you're using this 5% trailing stop, right? So now if the price is going from $100 to $110, your trailing stop loss moves with you, so it moves up 5%, right? Whereas, you know, if the price stays at $100, your stop loss stays at 95. But if the price of Apple has moved up to 110, then that trailing stop loss will automatically move up, you know, to keep you within that 5% range. So it would move up to 104. That way you're locking in profit. So if the price then suddenly does drop, you know, it's sold automatically for you at 104.5 and you've made a bit of profit. Now, that's one thing to keep in mind. So what I want to come on to now is doing your research. And right now we've got so many amateur traders who are jumping into positions based off what friends are saying or based off one big sort of news article. And what we need to be is very careful when we invest our own money. So there are certain things that we should almost definitely look at before we decide to invest in a company. So number one is the company's financials. What's their revenue like? What's their income like? What's their price to earnings ratio? What is the management team like? So have a look, you know, research their website. You know, what's the experience of their CEO or their senior leaders, because they are ultimately going to shape the future of that company. Another thing to look at is competitors. You know, how do they fare up against their competitors? An example is if you're looking at the NIO stock, well, have you looked at XPeng? Have you looked at different sort of electrical car manufacturers that might be competing against them? You know, how does NIO fare up to those? Another thing you need to ask yourself is, well, what could go wrong with that company? You know, for example, okay, they might have a great CEO now, but if that CEO leaves, does the vision of the company change, or will it carry on in the way that it's going right now? Another key one is, you know, how do they actually make the money as well? Because if you don't know that, you don't know where the revenues are coming from, you might not, you know, you might not know whether that company is successful or not if you don't know the answer to that question. Another great way is, you know, what are the professional experts saying on almost all sort of medium cap to large cap companies and further afield? You get experts and analysts giving you their forecasts for the year. You get, you know, different news articles, organizations that are constantly talking about, you know, the company, what they're doing. In fact, you'll get the company themselves often having news releases or press releases on their own website. So it's worth checking those out too. And of course, what rating is a stock given by experts as well? Sometimes companies are given a buy rating, a sell rating, a hold rating, and you know, often you can get 10s, 20s of amounts of analysts who will give you their ratings on a stock, and it's worth checking those out before you sort of buy or sell. Now, Another thing you need to keep in mind is risk management. So when you are looking at investing your money in companies or in the stock market, first of all, are you diversified enough? Have you just put your money in one stock and are just hoping that it will do well? Or in fact, are you diversified? So have you got some money in large cap companies? Have you got some money in medium and some money in small cap companies? Have you thought about the industries that you're investing in? Have you tried to go, okay, you know what, I'll put 2 stocks in the tech sector. I'll have 2 stocks in the electrical vehicle sector. I'll have sort of 2 stocks in retail, sort of diversifying. So if one industry's hit, you aren't hit altogether. Great examples are right now with sort of the COVID concerns lessening, you're getting airline stocks that are starting to rise, you're getting oil stocks that are starting to rise, whereas sort of the tech sector is taking a hit. So if you were diversified, you wouldn't be hit with the full amount. Great example is sort of Tesla right now. A lot of people might have put all of their money into Tesla, and whilst that might be a great long-term play, right now they are down dramatically. So the person themselves might be down a lot of money. So take that into account, guys. What's your split between a growth stock and speculative stocks as well? So that comes down to, growth stocks are more likely to be large or mega cap companies with a lot of revenue, a lot of money in the bank, whereas speculative stocks might be, small or micro cap companies that you might have a lot of money in, who might be very volatile. So assess the risk, make sure that you have enough money in companies that are going to continue growing, or have a bigger chance of continuing to grow, rather than speculative stocks. And remember, it's a marathon, not a race. You don't have to, or you may not make money overnight, but if you put money in the right companies with the strong revenues, with the good visions, the great visions that are matching the political sort of ideas at the moment and sort of going forward, then you'll be in a much better place than if you just sort of try and put all of your money in one stock overnight, and it might do well but it might not, and then you're completely out of the game. And the last thing, guys, number 1, take your emotions out of your decision making. A lot of people fall in love with one stock, or they're emotionally charged because one stock has gone really high, and they just put all their money into it. Do not do that. Remember, go back to what we've talked about. Investigate the company, understand how they're being perceived, understand what their revenues are like, what their debts are like. Make a decision based on your research, based on your risk methods. Don't go in based on emotion. Now, lastly, what I really wanted to discuss with you is about actually then entering the stock and exiting it. First question I want you to ask yourself is, does the trade make sense? Does it make sense to buy the stock at this price after having done your research in the company, after having evaluated the risk of your portfolio of stocks as well? Is it right? And is it the right amount that you're putting in? Secondly, what's the market condition like? Are stocks too overvalued? Like, you look at Tesla, and recently it's gone from highs of $880 per share down to about $670 this week. And you've got to ask yourself, is that an example of a share that's just way too overvalued at that stage? So have a look at a price to earnings ratio as well. Is the price of the share the right price for the amount of revenue that company is making? You can look at PE ratios to have a look at this comparison, and it's just one other way of making an informed decision based on research and based on the basics of a company and its value. Have a look at, is it worth waiting for a market crash or correction? Like, for example, we're going through one of those right now. Is now a better time to buy rather than when stocks are flying, because you know you will, if you get into the right stocks right now with the correct fundamentals, you'll get them at a discount price right now, guaranteed. They will be finishing the year a lot stronger. So now's a great time to do your research and get those so-called discounts on shares right now. And the third thing to look at is, how are you going to actually physically enter and exit the stock? My favorite method is laddering in and laddering out. Say you want to go into a stock, you like the fundamentals, you like the way it's looking. You know, if you want to invest, say $1,000 or £1,000 in it, start off with 300. Wait a while. Let's see what happens to that stock. If the stock starts going down or it dips, buy more. Buy another 300. That way you're averaging down, you're managing your risk, because not all of the money you wanted to invest is in straight away. If it starts going up, you can either take profits of that 300 or you can average upwards. You can in fact buy more as it is progressing. So it is a way of gauging the market without putting everything in all at once in terms of how much money you wanted to put into that stock. So it's a great way of going into a stock, less risk, and you can take advantage of dips, and advantage of the price rising. So in this instance, you know, no matter what happens to the price, you're still winning. If the price goes down, you're going to buy more. If the price goes up, you're either going to sell and take profit, or you're going to either purchase more as it goes up, or just hold it. So it's something to look into, and I would say have a look at other strategies as well. This is just one of them, and I'd say the research and the homework is the key to making success in the stock market. So that's all I've got for you today, guys. Thanks for listening. Don't forget to like and subscribe, and plenty more videos coming soon.